Welcome to Chapter 10, Relevant Costing for Managerial Decisions. So in this chapter, I will walk you through 7 different types of short-term managerial decisions. Decisions we have to make. We're going to have at least 2 alternatives with different outcomes, and we have to choose one of those alternatives. Short-term. In Chapter 11, we will be making long-term decisions, so we have to consider so-called time value of money. In this chapter, we will ignore the concept of time value of money. So here are pretty much the 7 types of decisions we're going to make. Evaluation of short-term managerial decisions. Describe the importance of relevant costs for short-term decisions. So first of all, we need to consider here not all of the facts that will be given to us. Instead, we will only be looking at relevant costs and relevant benefits or relevant revenues. By relevant, I mean those costs and benefits that will differ between the alternatives. So if my fixed expenses, fixed costs are not going to change with one alternative or another, I need to ignore them. So I will only consider those costs and those benefits that will be different between alternatives. So examples, if you're buying a new car, relevant costs would be how much this new car is, what's the sales tax, how will your insurance premium change, because they all take place in the future and they're all relevant or so-called incremental. And they're different depending on the car I'm going to choose. I also have to consider non-financial information like how comfortable this car is, right? The status of the car, the color of the car, so non-financial information. Irrelevant are those costs that do not differ between alternatives. For example, past costs. They are called so-called sunk costs. So the cost of the old car, how much I paid for my old car, is irrelevant here. That cost already incurred. It's not going to change. It happened in the past, cannot be changed. That's the definition of sunk costs. So relevant costs would be out-of-pocket costs, any future payments associated with my decisions, right? My future payments, repairs, gasoline for the car, insurance, as I mentioned. Also opportunity costs. What do I give up? My potential benefits given up when I select one alternative over another. Your choice to take this class results in opportunity costs. You're spending this time studying instead of working and making whatever your average salary is. $15 per hour, $20 per hour, $100 per hour. That's an opportunity cost you give up. Opportunity costs are relevant decisions. When you see this reference to exercises or quick studies, I will send you solutions for all of those exercises and quick studies referred to in these PowerPoint slides. They come from your book, so you can look at the instructions in the book and then you can find the solution. For example, I'm referring to here to quick studies 2-1, 2, 3, 10-5. So let me take a look at 10-1 and 10-2. By the way, I'm mentioning again that non-financial information, we cannot ignore it. We're not spending much time here talking about it, but we should. Qualitative factors. If I decide to outsource my production, what happens to my manufacturing factory plant? Is it going to be closed? What about laying off employees? What about quality matters, right? So quick study 10-1 and 10-2, this is your textbook. In quick study 10-1, we have this scenario. Helix company has been approached by a new customer and they want us to sell them 2,000 units of our product at a discounted price of $6 per unit. Usually we sell it for $8. But this $8 is irrelevant. We're going to look at $6 and we're going to also make sure, do we have enough capacity? We're operating at 75% capacity of 10,000 units, so we still have capacity for 2,500 units. So right away, look at the capacity. Do you have enough capacity? Follow through. If you don't have enough capacity, you're not going to give up your $8 units to produce $6 units, right? So don't take the offer if there is no capacity. Identify whether the following costs are relevant to Helix's decision as to whether accept this order or not. No additional fixed manufacturing overhead will be incurred. The only additional selling expense in this order will be 50 cents per unit shipping cost. So when you look at all of this, your regular selling expenses, your fixed manufacturing expenses, and your administrative expenses, they are unavoidable. They will not be avoided. If you make more units or fewer, well, here it's more units, you will not have more fixed overhead or regular selling or administrative expenses. So they will be not relevant, irrelevant. Everything else is relevant. So I have this solution file right here, which you will have access to. So relevant decisions, relevant facts to the decision, not relevant. And in quick study 10-2, we are preparing an additional operating income. I'm not making the whole income statement. I'm just looking at the incremental analysis. What's the new revenue? $6. For 2,000 units, $12,000. What's relevant? Direct materials, direct labor, variable manufacturing overhead, and additional selling expenses. I am ignoring fixed overhead, regular selling, and administrative expenses because they will not change. I just look, this is incremental analysis. I just look at relevant revenue, relevant costs. So even if I take this order for $6 per unit, I will still make $1 per unit, which results in $2,000 of additional net income. Since I have capacity, I should be accepting the offer. So again, you will have access to those solutions. So these are my 7 types of decisions we have to make. 7 types of decisions. Here they are. So as you see, we will make incremental analysis. Instead of focusing on the entire income statement, we will just look at how operating income would change under each alternative. In the previous example, we just looked at one alternative. And guys, 2 keys, we will only focus on, as I mentioned, relevant revenues, costs, and net income. Only on relevant, incremental, another term, incremental, additional. And instead of using regular absorption income statement, we will use contribution margin, where we separate variable costs from fixed. Okay, this is a great slide. I prepared it for you. Your textbook doesn't do it. Like, this is 7 types of managerial decisions. So I'm going to go over additional business, outsourcing, scrapping or reworking, selling or processing further, sales mix, segment elimination, keep or replace equipment. These are methods we're going to use. So this is a great slide. So additional business, we will use CM, incremental income statement, additional business, right? So here is an example. We're selling 100,000 units. We are not at capacity. We have capacity. So right away, is there capacity? Yes. Do go through the analysis. If there's no capacity, you are not going to take the decision of additional business. So it's called additional business. Usually you have an offer. A current buyer wants to buy 10,000 additional units at $8.50. Currently, we're selling them at 10. They want us to sell it to them for $1.50 less. Should we accept this current price or not? So you see, this is the current contribution margin statement. I want to mention right here, guys, that usually fixed costs right here and administrative expenses, most of the time they don't change. So they might not be relevant. So as I said, do we have excess capacity? Yes, consider further. If no, reject the special order. Look at the incremental costs versus revenues, right? If revenues are greater than expected, relevant or incremental costs, accept the special order. If we're going to lose money, reject the special order. So additional information. Variable costs are the same, but I still have to consider them, right? Right here, I have to consider them because they are direct. I will incur these additional costs with producing each additional unit. Selling expenses are only 20 cents per unit. So instead of, if you go back, selling expenses is $1.40. For this additional order, it's only 20 cents. So these are all relevant, right? Not the entire selling expenses, just 20 cents. So new selling price, $8.50. I subtract all my variable costs. I subtract new selling expenses. My contribution margin is $2.10. I want to remind you, they want to buy 10,000 units, so it's $21,000. Guys, fixed overhead is the same, so I ignore it. Administrative expenses is only an additional $1,000. So my previous administrative expenses of 80,000, I ignore them. I'm going to have them no matter what. I'm just going to look at the relevant incremental $1,000, which is 10 cents per unit. So my offer, this additional special offer, will make me money. It will make me $2 per unit or $20,000. I should accept the offer. So there is another example of this type of decision, quick study 10-6. Okay, next one. Let me go back for a second to my summarizing table. Should I make the part inside or should I buy it from the outside? Outsource or not? So we're going to compare our variable costs with the purchase price. If I'm going to make this part inside, what would be my variable costs? Versus if I outsource, how much do I have to pay for it? And another question here, is any of the fixed overhead avoidable? If I outsource and I don't have to produce it, can I decrease my depreciation? Can I decrease my variable, I'm sorry, not variable, fixed overhead? So here is an example. Outsourcing, right? Outsourcing. So we're going to look at variable cost compared to outsourcing price. So we manufacture an optical switch that we use in the final product. We produce 68,000 of those switches. These are total costs, right? Direct materials, direct labor, variable manufacturing overhead. Again, I'm going to just focus on variable costs, and I will divide them all into 68,000 just to see per unit what's my direct materials per unit, direct labor, variable overhead. Fixed overhead, I'm going to ignore unless it's going to change. Unless if I outsource, I can save some of that fixed overhead. So we don't know yet how many switches we will need this year. However, a different company offers us to make it for us and to buy it from them for $13.50. So we have to look at variable costs per unit and compare them with the purchase price. Whatever is lower is the better alternative. If Tech System buys the switch from the outside supplier, the manufacturing facilities will be idle. They cannot be used for any other purpose. So none of the fixed costs are avoidable. This entire fixed cost I still have to incur. So 3 questions. Given the same cost structure, should we make the switch or buy the switch? So here is the analysis, right? I took the information given for direct materials, direct labor, variable overhead, just for variable costs, divided by the number of units, right, switches. So my variable cost per unit is $12. The company is offering to sell it to me for $13.50. So it's more expensive to outsource. So I should continue producing it. I should continue making the switch in my factory because it saves me $1.50 per unit. A second question here says, well, assume now that out of this 408,000, we can avoid 97,000 by outsourcing. In addition, because sales are increasing, we need to make 73,000 switches rather than 68,000 switches. So this is what we're going to have. My variable cost, I just take from part 1 right here. Variable cost is $12. Multiplied by number of units, so my variable cost is 876,000. My fixed costs, if I continue making, right, this column is making switches in-house, is 4 or 8,000. But if I buy switches, I pay $13.50, I'm sorry, for 73,000 units, and I can avoid $97,000 of fixed overhead, so my fixed cost will be only 311. Still, if I make switches, I spend 1,284,000. When I buy if I buy switches, I would have to spend more. So it's still cheaper for tech systems to make our own switches rather than outsource them, because it's cheaper. And the last question is, a little bit more complicated, but given the last scenario, what would the most we would be willing to pay to outsource the switches? And this is this decision number 3. This is the formula, right? I want to find break even. Like, what is the amount when cost of making switches is equal than cost of outsourcing switches? So above that amount, I would be willing to outsource them. And guys, any cost is variable cost plus fixed cost, right? So this is the formula how I plug in my variable cost. If I make in-house, $12 multiplied by 73,000 units, they told us number of units. My fixed costs are 408, so I take all of this information from here. And if I outsource, I know the number of units, I know fixed cost. Well, what would be the variable, what would be the purchase price, right? And when I solve for an X, I get $13.33. So if I can go back with the offer to the manufacturer, if you charge me $13.33 or less, at $13.33, it doesn't matter to me. I can buy, or I can outsource, or I can make in-house. If they sell it to me for $13.32, then it would be cheaper for me to outsource. Okay, the next scenario, should I scrap or rework? Often in manufacturing processes, we have products that do not pass inspection. We can either sell them as is, or we can work on them to improve the quality. So as long as the rework costs are recovered through the sale of the product, and rework does not interfere with our normal production, we should rework rather than scrap. Costs incurred in manufacturing units of product that do not meet quality standards, like how much I already spent on making this, does not matter, because it's a sunk cost. It cannot be recovered. It's irrelevant. So here is an example. We have 10,000 defective units that cost us $1 each to make. That $1 I ignore. It's a sunk cost. Who cares, right? So right here, this is irrelevant because it already incurred. The units can be scrapped now for 40 cents. So if I scrap, I get 40 cents. Incremental income, 40 cents. If I rework, I will incur additional cost of 80 cents right here. And if reworked, I can sell them for $1.50. So $1.50 minus 80 cents gives me the difference. But there is one more thing. Reworking the defective units will prevent production of 10,000 new units that could be sold for $1.50. So this is my opportunity cost. It's relevant. I can, if I'm reworking, I cannot be making new units, and I would sell those new units for $1.50, but it took me $1 to make them previously, so I have an opportunity cost of 50 cents. So I consider it right here. So I subtract not just out-of-pocket costs to rework defects, but also opportunity costs of not making new units, 20 cents. So what's better? Where do I make more income? Right here. I should be scrapping because my incremental net income is higher than if I rework. We should scrap the units now. Okay, decision number 4. Sell or process further. As a general rule, we process further only if incremental revenues exceed incremental costs. Here's an example. We have 40,000 units of partially finished product Q. Processing costs to date are 30,000. Who cares? That already happened. That's a sunk cost. We ignore it. The 40,000 unfinished units can be sold as is for $50,000. So if I sell as is, I keep $50,000. Or I can process them further to produce finished products with an additional cost of $80,000 and total revenues of 150. So if I process further into products X, Y, and Z, I make 150 revenue minus 80,000 cost. I would make $70,000. Which incremental income is better? Of course, I should here process further, right? This is better. So I should process further. By doing so, it will earn me an additional $20,000 of income. So there's another quick study here, and you will have access to the solution of that quick study. Decision number 5, sales mix with limited resources. I have so many employees, so I have so much of the machinery. I have a limited resource. I have a certain number of machine hours, and I'm making all these different products, but I should focus on a company which is on the product which is more profitable. If my production facilities or other factors are limited, I should focus on one type of product, more profitable, because if I produce more of one product, it means I have to produce less of the other. So we're talking here about sales mix. So the method that we're going to use, and again, I can go back to my summary slide. So when we're talking about sales mix, we're going to use contribution margin per unit of that scarce resource, whatever that resource might be. Oops. Here we go. So here is an example. Let's say I make products A and B using the same machine. These are my selling prices. These are my variable costs. So I can calculate contribution margin per unit. And if I look at the contribution margin, product B looks more profitable. However, I should be looking at the contribution margin per unit of that scarce resource. And my scarce resource is the machine hours, right? Machinery. It takes me 1 hour to produce 1 unit of product A. However, it takes me 2 hours to produce 1 unit of product B. So I take the contribution margin and I divide it by the number of machine hours. Now we can compare, and I can see that product A in this example is more profitable. I should focus everything, since I have limited machine hours, I should be producing product A and not product B. So contribution margin per machine hour. We should produce more product A. And again, there is an exercise here, 10-11, and you will have access to the solutions. Segment elimination. When we have different departments or segments, we talked about it a little bit in chapter 9. A segment is a candidate for elimination if its revenues are less than its avoidable expenses, right? We have to keep in mind that when we eliminate a department, it doesn't mean that some of the costs like rent or insurance or depreciation will go away. It does not mean that every single expense or cost will go away. I should only focus here on relevant, or we will call them avoidable expenses. And I should not be looking at unavoidable expenses. So avoidable expenses are amounts the company would not incur if the segment is eliminated. And unavoidable, I will still have to incur. So I have a trade mill division because it reported a $500 operating loss for the recent year. So this is my total, right here. And my division, the trade mill division, has a loss of $500. But I should not be looking at the total net income. I should separate all these costs into avoidable and unavoidable. So cost of goods sold is unavoidable, right? It's avoidable. If I eliminate this division, I will not have COGS. Wages are avoidable. But depreciation, I still have that equipment, Even if I eliminate this division, this depreciation cost, I will still have to incur. So I have to ignore it. It's unavoidable. It's irrelevant. Whether or not I keep this division or not, this cost is the same. So I should not be looking at it. And so on so far. So we go through rent. I will still have rent. Advertising. We can avoid advertising. Blah, blah, blah. And then I look at the difference between, so these are my total avoidable expenses, and I look at $47,800 minus avoidable expenses gives me $41,800. So I am still going to keep this department because its avoidable expenses are higher. I'm sorry, the difference between revenue and avoidable expenses is positive. And the 6,500 I would still incur, so I ignore them in my analysis. So if I eliminate the division, I would lose $6,000 in income, so my outcome do not eliminate. And you have a quick study here. And I think the last one, should I keep an piece of equipment, or should I replace it? It could get complicated. You know, my newer equipment, I have to pay for it, right? But it can lower my manufacturing costs. It can lower my variable manufacturing costs. It can even lower my, direct labor sometimes. So I have to consider out-of-pocket cost, like my net purchase price, whatever I have to pay for equipment. Also, maybe I can trade in the old piece of equipment, so that's a cash inflow. And I have to look at the reduction in variable costs versus net purchase price. If my reduction, what I save, is higher than purchase price, I should replace. If it's lower, I should keep the old equipment. And here we have a machinery with book value of $20,000, right? But who cares? That's old information. That's a sunk cost. And remaining useful life of 4 years. Its market value is 25,000. Well, that matters. That means book value doesn't matter. But market value means I can, if I replace it with new equipment, I can trade it in. I can get $25,000. We can buy a new machine for 100,000 and receive 25K for trade-in. The new machine will reduce variable manufacturing costs by 18,000 per year. And so we're looking at 4 years, right? 4 years that are left. So I'm looking at net purchase price, 100,000. I put it negative because it's the cash outflow, right? I have to pay 100,000, but I will get a refund, or I will get 25K for trading. And then I am comparing it with the reduction in variable manufacturing costs, which is $18,000 per year multiplied by 4 years, because I am replacing the old machine that would still be useful for 4 years. So that gives me positive 72,000. That's pretty much how much I will save in variable costs in 4 years. So total decrease is 3,000 negative. I should not be replacing equipment. It's more expensive. The net purchase price here is higher than reduction in variable manufacturing costs. My net purchase price is pretty much 75K, but it will save me only 72K. So I should keep old equipment, not replace. And that is chapter 10. Thank you so much and take care.